Have you ever wondered if it's possible to make significant gains in the stock market while you sleep, i.e., passive income? Are you earning PDT and struggling with the fact that you're unable to trade daily? Are you concerned with the risk of holding options contracts longer than a day and unsure if it's worth it? What's up, everyone? This is Eric with Theme Options Trading, and today I'm going to discuss how I made over $3,000 trading Tesla overnight with options. The best part, I only used $600. $600 to make an over $3,000 gain in less than a day. I will take that every single time. In this video, I'm going to discuss my reason for entry, my reason for exit, and so much more. Let's get started so you too can learn how to make $3,000 daily trading options. Okay, so here we are looking at Tesla on the daily. Before I start any trade, I want to start off by looking at the daily chart so I can get a bird's eye view picture of the stock first. If this is trending up and I have a short bias thesis or I want to long a put, my data better support that because I'm trading counter trend. Not to say it can't be done, but the data better support that thesis. Let's look at Tesla, starting with the daily. Here we have Tesla trending up. Almost hits 300. Earnings do not meet expectations and has been in a downtrend ever since. Each push has gotten eaten up. Textbook bearish signal. Lower highs. The bears are in control here. This is great, but what is the 30-minute telling me? Because intraday themes and intraday market cycles do provide clues of what can happen with the macro picture. So while the macro picture does support a bearish sentiment, let's look at intraday patterns and themes and behaviors to see if these two can align with one another. Okay, let's look at the 30-minute here. What do we see? We see some consolidation, a breakdown lower, a test of this liquidity zone, and a reject. So the micro behavior does align with the macro behavior. This is in our favor, and we can extract edge from this because the two are aligning for another. And further, my data supports this. Before we move on, let's identify some key levels. I am huge on key levels. They are a pretty basic concept, but they're effective. I don't care how basic they are if they work. Let's look at some key levels so we can identify our risk and our reward and make sure that the math aligns with the trade here. We have around 183 as a level that has been tested. We have on the bottom here around 172. The low of about 160. The high of this minor liquidity zone of around 165. Okay. So is this math going to be in our favor? What we want is a breakdown of this 172 level. What would be our profit target? The next key level of 165. So about a $7 from an equity standpoint reward here. Where is our risk? And this is where things get a little more complicated with options, because if we're trading this overnight, we cannot stop out. So we need to size appropriately. In an ideal world, what would prove this trade invalid if we broke lower past 172? A reclaim of that on volume. Very basic, not all the time, but from a general sense, if we break down this key level, if we break down below this key level and reclaim it, thesis is invalid. Not 100% of the time, but a good rule of thumb. But we don't have that luxury if we're trading overnight. What do we need to do? We need to size appropriately. So how do we know that this is going to prove it invalid? I know this pattern, but look at this major liquidity zone here on the left. This is potentially like a magnet. How is this acted? We tested up, down, up, down, tested, up. Behavior change, break lower. This is the level of interest. We tried to fake this breakdown here and push higher, but we couldn't. Confirmed the bearish sentiment. So this level is our invalidation level. If we break down lower and reclaim, not in favor of us. We might get lucky and we might run out of steam like we did here and continue to push lower, but that is not what we're trading. I want this to work overnight. I want it to happen fast. That is just with options in general. I want it to happen fast because the Greeks are not in my favor. Expiration is continually approaching, and this needs to happen fast. How do I take this all into consideration? I size down. So I have a trade plan. I want this to break lower. I can do one of two things. I can either wait for the breakdown and enter, or I can wait for a weekday, a push, and short strength. How do we short strength in options? We long a put. I will never naked short an options contract. The risk is too much. So I have a plan here on the 30-minute. Now I need to look at the 1 minute to try to identify an entry signal. So here it is, Thursday. This is the day I traded this thing. We opened and we immediately dumped. What happened next? We pushed higher, eaten up, down. Remember the daily? What happened? The push, eaten up, rejected, lower highs, textbook bearish sentiment. Does this intraday pattern align? Absolutely. We try to have a fake breakdown of this key level. We push lower, push lower, push lower. What do we think is going to happen here? Push in lower. I need to short strength. Let's look at the 1 minute chart and see if we can identify an entry signal on the 1 minute to set us up in a decent position for overnight trading. Tesla on the 1 minute chart. What do we see here? Push, eaten up. Push, eaten up. Push, eaten up. Textbook, lower highs. Does this remind us of a pattern that we've seen on the daily? Absolutely. Does this intraday behavior align with a macro picture? Absolutely. What an A+ setup for us. I could have done one of two things. I could have shorted weakness or shorted strength. What did I choose and why? Well, if we look here, here was the key level, 172. As expected, we tested this and bounced. Expected behavior. This is great, but now I need to find an entry signal. What is my signal for entry here? I want three things to be true for this trade. One, I want to pay as little as possible for my options contracts on this trade. What's the age-old saying? A penny saved is a penny earned, especially for a trade that is considered high risk, adding major quotations there. I want to pay as little as possible. Second, I want this trade to provide me an entry signal with about 1 hour left until close. That's what my data supports, so that's what I want. Third, I want to short strength, or in the case of options trading, long a put. I do not make it short. I want to long a put on strength. Why is that? On this day, the bears are clearly in control. Do I really think the bulls are going to come through and win the day? No. If it does, that's unexpected function and a loss for me. On to the next one. So what I want from a game theory perspective is the bulls or the longs to think that there's a light at the end of the tunnel. What would that look like? A push above a micro key level on above average volume. That's what happened. Look at this. Some consolidation here. A micro key level. Push on above average volume. This is going to trap out all of the longs who have been waiting for a change, who have been waiting to get bailed out on this weekday. Not going to happen. Push. This is about where I entered. What happens next? I don't care. It's either going to work in my favor or not. Whenever I clicked buy here, that's me saying this trade, that's when I'm committed. emotionless trading. It works or it doesn't, and then I move on. How did I know which contract I wanted to select? What's my profit target here? 165. In a perfect world, we would hit 165, but is it always the case? No. So I could either purchase a 165 put contract or have a contract that becomes in the money in the middle of the move. My data supports, and for my risk tolerance, that's the contract I want to purchase. Where does that leave us? 170 put contract. That's in the middle of the move. And if we get to 165, it'll be in the money. All right. Now we entered with about an hour left, and we have after hours in pre-market to overcome. I have a love-hate relationship with overnight activity. Why? Because it can work in my favor majorly. It can gap down or gap up in my favor, and my contract value will reflect that significantly. What else can happen? It can go against me. That's a risk. Why is that a risk with options trading? Because you cannot exit. These cannot trade overnight. So if this goes against me after hours, I have to sit on the sidelines. If it goes in favor after hours, I have to sit on the sidelines and wait until the next day, the market open, to exit my position. How do I account for this risk? Size down. In this case, only $600. For me, that is relatively smaller size, but that's okay. I know that if this works in my favor, that the gains will be worth it. So I'm fine with trading only 10 contracts on this because I know a gap in my favor could prove huge. Let's look now at pre-market activity and the market open to see if this works in my favor. All right, what happens? We have a dump and a breakdown of this key level 172. How far down do we go? Around 165. Do we remember what level 165 is? That's the macro level that we identified as a key level. So the bounce here is expected. This would have been a decent exit, but this is pre-market. So what do? We wait. We see what's going to happen. What happens market open? We push higher. What do I do here and why? I exit almost immediately at the open. Why almost immediately? We'll get to that soon. If this would have broken past 165, would I have exited immediately also? Absolutely. I would have rolled this contract down because I know that the way that out of the money contracts trade versus in the money, out of the money contracts with a more favorable move, especially with 0 DTE, which is what this contract had, can pay off more than an in the money contract. I want to extract as much money as possible from a trade, so I would have rolled this down. So regardless of what would have happened at the market open, I'm going to exit. If I rolled down, I would have waited to see, would we have reclaimed this 165 or kept going lower? Doesn't matter. That's not how I traded, but I exit at the market open. Why did I say almost immediately? Because how big was the spread here right at market open? This thing was trading $3.20 on the bid or $4 on the ask, an 80-cent spread. How many contracts did I trade? 10. How much money is that? An $800 differential between the bid-ask spread. I market sell this. So what did I do? I waited. I waited for the spread to close. If it closed to the lower end, that's fine. I was already expecting to pay $3.20. But if the bid-ask spread closed to the higher end, even better. What happened? It closed on the higher end. It was trading at $3.95, $4, about 20 seconds or so in. And I top ticked the exit on the put. Doesn't always happen that way, but in this case, it did. And I ended up making $3,400 on this trade overnight. Talk about a gap in my favor. The stars aligned perfectly. Sometimes it's more than a $3,400 gain, sometimes it's less. Doesn't matter. This strategy that I trade has an edge. I have an entry signal, I have an exit signal, and that's it. Emotionless trading. I expect my position, if it doesn't work in my favor, to be worthless the next morning. Is it always the case? No. That is for the mental part of trading for me. When I place a trade, I'm fully expecting that to be worth $0 the next day. Is that always the case? Absolutely not. But it's this mindset that allows me to accept the risk. What is your risk tolerance? Maybe it's $100. So maybe you only purchase one contract or two contracts, $60, $120. You have to be okay with losing that overnight because it's possible. Doesn't always happen, but it's possible. This is how you get to the point of emotionless trading overnight. You scale your size down and you are okay with losing the money. What happens if you don't lose? You could bank majorly and make more than 5 times of what you entered into the trade. This is a trade you have to add to your portfolio. This strategy alone can help grow your account. The best part, it's not intraday. So if you have a small account that is under PDT, you can add this, you can trade this, and you can grow your account substantially. This is why I love options trading. You can turn $600 into $4,000 overnight. Does this happen in equities? No. You'll notice earlier I mentioned that I wanted to trap the longs. Where did I get this mindset of trapping the longs from? Game theory. If you want to learn more about game theory, click the link below and download my free ebook discussing game theory in the stock market. And that's it. Subscribe, like, until next time.